Yes, sir.
All right, so next week, just looking at the main thing that I always go to is like stock market catalyst this week. I usually like this Market Watch U.S. economic calendar. We're talking macro here. Oh, I guess I should do a disclaimer since we're on YouTube Live. This is not investment advice. Please consult your broker, licensed professionals, etc. This is how I invest, but I am not licensed in any way. This is not investment advice. So, with that being said, this is what I'm anticipating for next week. I always look at what the major U.S. economic reports and Fed speakers are going to look like because these are the things that are going to potentially move the market up or down. Um, Wednesday, we got CPI. That's probably just looking at next week. You got a couple of Fed speakers on Thursday afternoon. But and you got PPI on Thursday. These are going to be the biggest market movers. Mostly CPI on Wednesday. What is CPI? It's the Consumer Price Index or inflation data. The Fed's major, it's two major things that it does in terms of its mandates are keeping inflation down and keeping employment up. So the CPI data is going to tell us what the inflation was like over the last, what was it, month in March, right? So looking at CPI right now, the forecast is 0.3% in terms of what the rise is going to be. And so if that comes in hot, if it comes in at zero point 0.4, zero point 0.5, 0.6%, zero point 0.4 wouldn't be so bad, but zero point 0.5 or 0.6%, market might come down. Why? Because if inflation is going back up, the Fed is less likely to lower interest rates. And if the Fed is less likely to lower interest rates, that is bad for stocks, especially for companies that need to borrow money. It's going to be more expensive to borrow money, which means growth is going to be less likely for those companies. So that's really why the CPI numbers next Wednesday are going to be important. If it comes in light or in line, if it comes in at 0.3% or 0.2%, then the market's probably going to rally. Why would the market rally? It's because maybe they think the Fed is going to cut interest rates sooner in June instead of July. If you look at last week, what was that on Thursday? This guy or woman, I'm not sure if it's a man, Loretta Meester, and she may be female, just I assume because her name is Loretta. Uh, but once she started speaking at 2 p.m. on Thursday, that's when the market dropped because she said if inflation comes in a little too hot, we might have to pause for longer, which means it's going to take a little bit longer for us to cut interest rates, which means interest rates are going to stay higher for longer. So, really, our next piece of data that's going to come in that's going to indicate whether or not inflation is hot or not is going to be core CPI on Wednesday. So if it's at 0.3%, it's going to come out at 5:30, so an hour before the market opens, right around when pre-market opens. So if it comes in at 0.3%, it's in line. The market's probably gonna, not do much or feel better, at least about inflation. If it comes in low or light at 0.2%, market's likely to rally. If it comes in too hot at like 0.4, 0.5%, market's likely to fall. Especially the stocks that are dependent on lower interest rates, right? So that, depending on what these Fed speakers say too, they say something crazy, market could go up or down. Or if they say something inconsistent with Jerome Powell, who still said he first saw like two or three interest rate cuts by the end of this year, market could go down. PPI is another inflation reading number, but lately what I've been seeing is that CPI has been moving the market more than PPI, and PPI has been coming in line with CPI. It's an inflation reading, but it's pretty similar to the PPI, just some different measurements of different things. Um, and you got jobless claims on Thursday, which I think are less important than inflation right now. But I think those are the things that are going to move the market. So if you're trading, be careful on Wednesday, be careful on Thursday. You at least want to see what the direction of the market's going to be before you start trading on Wednesday or Thursday, because those are going to be huge. All right, next, let's talk about earnings. I always look at what's reporting the next week. We're still in macro. What's the overall market look like? Is there something that's going to be reporting earnings that's going to move the market? So Monday, not much of anything that's huge. I'm usually looking at a huge market cap company. Tuesday, nothing huge. Wednesday, you got Delta. That's going to move the airline stocks. If it reports really great earnings or really terrible earnings, it's probably going to move the other stocks with it. Looks like it's going to be the first airline company that reports. Thursday, nothing huge. Friday is the huge day. 12th, we talked about this last week. JP Morgan, Wells Fargo, Progressive, BlackRock, Citigroup, State Street. This is going to be the start, the official start of earnings season is going to be on Friday. Is all of the, or what, 5 or 6 of the biggest financial companies are going to be reporting earnings. And then that's going to move the stock market. If they do well or if they tank, it's potentially going to move the stock market. All right. But that's Friday is going to be the big day. And it looks like they're all reporting in the morning too. The sun right here means that they're reporting probably at like 5:30 before the market opens. Let's see, what else? Okay, so we talked about those two things, macro. Number 3, it's like I've showed you previously like how to find an earnings report. So let's say JP Morgan comes out Monday morning and you want to get more in depth because you're interested in investing in JP Morgan long term. It is like the best of breed right now in terms of like banks, big banks, JP Morgan. So I always go to the investor relations tab. I'll type in the ticker symbol and type in investor relations. Every company, every publicly traded company is going to have an investor relations page or tab somewhere, right? So if you go there, this is where they're going to post their earnings in the morning when it happens. If you got bots, which a lot of hedge funds and whatnot and people have created to grab this stuff early and trade it, it's really hard to trade and read through an earnings report at the same time, especially when people have computers and algorithms and formulas doing this for them. But sometimes, let's say a stock will drop after it reports earnings. But if you go look at the earnings report and you're like, damn, this actually isn't that bad, I want to buy it, you know? That's actually one of the reasons why I got into Google. When I got into Google, I liked 2 things about it. It was dropping near its 200-day moving average. And number 2, before I bought it, I looked at its earnings and I was like, oh, Google actually, did really well on earnings. Like, it didn't knock it out of the park, but like, I'm looking at their last earnings period. Look at their last earnings. They beat on the earnings per share and they beat on the revenue. So I was like, why is this stock taking 15% if it's doing well? So that was kind of when I was like, oh, I think this is a good time to buy it. Like it did better than people expected on the earnings per share and the revenue numbers. And, maybe some guidance was a little off, but it looked really good. And if it's dropping 15, 20%, I was like, oh, that's a good grab for it, right? So that was one of the reasons why I bought Google, is because I went and looked at their earnings. I went in the report, looked at their earnings segments. Things look good to me. I told you I'm a big believer in YouTube because my daughter is into YouTube and she's 5. So I assume YouTube is only going to get bigger. I've started advertising on YouTube too. So like, I feel like that's its sector. And recently Google just advertised or there was news that came out that they were in talks with Apple to be in all of their phones using Gemini. Their AI is going to be potentially integrated in all the iPhones. So like that happened after the fact, but I looked at their earnings report to kind of figure out like, hey, is this something that I want to own potentially long term or do a long term leap on it, you know? So this is where you're going to find them. Typically, the press release, the presentation, or the 10K. The 10K is going to be more dry, where you're going to find like all of the charts, all of the balance sheets, the financial statements. But sometimes companies will put together, you know, good press releases that'll give you like snapshots of like what their revenue is and whatnot, right? So JPM is best of breed right now of the big banks. But you know, if you go to Google and type in JPN earnings, for the biggest stocks, they'll usually tell you what the expected numbers are, right? What they expect. So this is their bar right here. If it if it reports revenue greater than 4.172 billion, chances are the stock is going to do decently well. If it reports an earnings per share over 4.13, chances are the stock is going to do decently well. It's also going to set a bar for Bank of America and any other bank that reports after it. If JP Morgan blows out its earnings and kills its earnings report, Bank of America, who's probably going to be reporting in the next week or so, in the next couple of weeks after this, is going to need to, you know, really have a really good earnings report because their major competitor had a really good earnings report. But if JPM doesn't have a great earnings report, it's going to lower the bar for the other banks and other financial institutions, right, in terms of what they're going to be expected to be reporting. But so that's JP Morgan. I'm not going to go deep into their earnings and whatnot, but I just wanted to show you for any company, if you're looking from a fundamental standpoint of how much money is this company making, are they growing quarter by quarter, year by year, go to the investor relations tab. And you can go view the one from this quarter, last year, you know, forward-looking statements, what they think is going to be happening in the future, to just get a sense of where you think this company is heading from a fundamental standpoint. All right, last thing before we start getting into charts, we get into Thinkorswim, is going to be this new website that I found, this new app that I found through this trading class that I'm taking right now called Koifin. This is the free version. And really, in the new class that I've been taking, we've been going here to figure out what sectors are up and what sectors are trending down, right? To figure out where we're going to be trading. So as we saw at the beginning of this year, tech was up, right? Semis up. Right now, that is not the case. Over the last month, what do you see has been up? Can you see my screen?
Yeah, I'm zooming in to look at it. Looks like energy, right?
Yep.
Energy.
XLE,
Yeah.
energy, XLC, communications, XLI, industrials, XLF, financials, banks, right? So that's been this month. And then KRE is regional banks. So what's been up the most? Regional banks, financials, industrials, communications, and energy. What's been down over the last month? Chips, healthcare, XLY, and XLK, tech. Tech has been the worst performing over the last month. So if you've been doing calls on tech over the last month and wondering why it hasn't been going anywhere, it's because tech hasn't been performing well at all. It's been pretty much even. If you look at this green line, it's been hovering towards even, you know, and a little bit negative, 2% negative over the last month, right? So if you're looking at the trend is your friend. Where are you heading right now from a day trading? If you're trading stuff, that's what you're looking at. It's like you're looking at the hot stuff and then ideally waiting for that hot stuff to have a pullback and then keep going back up. But these are the areas that you're looking at, right? So we look at, all right, so then what I've been telling you guys recently too is, so let's say we look at XLE. XLE is an ETF. These are all primarily ETFs, right? What is ETF? And what are ETFs? It is ETFs are funds that have a bunch of stocks in them, right? And then they're weighted differently. So if we look at XLE, it's kind of, just to give you a more general definition, it's essentially a way to trade a bunch of stocks at once, but inside of one instrument. So if we look, I will type in XLE holdings and then go see what's the heaviest weighted stuff in XLE. Exxon, Chevron, ConocoPhillips, Marathon, EOG, Schlumberger, Phillips, Pioneer, Valero, Williams, right? So if I'm trading and I want to look at what's hot, these are the stocks that I'm going to want to look at because all of these stocks compose the hottest sector right now. You feel me?
Got it.
Right. Same thing. So XLC is the second hottest sector over the last month. I'll do the same thing. I already know what's in these things because I look at them all the time, but just to show you what's in XLC, what are the major holdings and how it's weighted, you got Facebook, Meta, Google, Verizon, Netflix, AT&T, T-Mobile, Electronic Arts, Walt Disney, Comcast. I know from looking at the market what's been holding this up has been Meta, Google, and Disney, all three, and Netflix. Those four have been on a tear lately, So that's why when you look at the sectors, why XLC is the second best performing sectors. They have Meta and Google in the communications ETF. It is also in other ETFs, but communications in general, if you look at the stocks, like all four of those have been performing pretty well over the last month or so. Not crazy like the energy stocks have, but they've been doing pretty well. So if I were in tech, and I've told you I already have a position in my long-term account on Google, but if I were in tech, where is it? That's where I would be. I would be in Meta, Google, Netflix, and Walt Disney isn't really tech. Disney isn't tech, kind of, sort of, because it has streaming. But if I were in tech, those would be the names I'd be in. Right now, anyway. And waiting for a pullback on those names that have a better trend than XLK, the Apples and the Microsofts and Nvidias right now. XLI, same thing. That's been up. What's in XLI? The industrial. This is kind of like a NASDAQ-based ETF. XLI, Caterpillar, GE, Uber, Union Pacific Railroads, and then these others too. But the heaviest weighted, Caterpillar, GE, Uber. You guys, these are decently heavily weighted too, right? So that's kind of what you're looking at. Just to go back to XLC, you'll see the weightings are a little bit different. Meta is 24% of this entire ETF. So if Meta goes up, what's likely to happen to XLC?
Go up also.
Yeah. And then if people are buying XLC, what's likely to happen to go to Meta?
Go up.
Yeah. Because if you're buying XLC, you're buying Meta too. If you're buying XLC, you're buying Meta, Google, Verizon, Netflix, and all of these things. So if people are buying this ETF a lot, chances are all the names within them are going to go up too. So really what I'm showing you is just like how to target strength in the market. We're in a bull market right now, because we keep getting higher highs, except for this last week. We kept getting higher highs on the S&P 500 and the Qs, at least since the beginning of this year, if we're talking about the beginning of this year. So if we're in a bull market, where you want to be is in the places or in the names that are going up still. So right now, over the last month, we don't really want to be bearish because the market hasn't been bearish. It's been trending up. So where do we want to be? We want to be in the strongest stuff that is going up. And I just showed you where all the strongest things are. And then financials is the last one over the last month. XLF, top holdings in XLF. Berkshire, kind of stay away from Berkshire because that's really expensive. But JP Morgan, Visa hasn't been doing so great, but MasterCard, Bank of America, Wells Fargo, a lot of the Progressive, a lot of the things that we'll be reporting on Friday, right? So that's kind of what I've been, so if I'm day trading, if I'm swing trading on like a slower or a smaller time frame over the next week or so, here are the sectors that I would be most likely to swing trade. But looking at SMH, which is the chips, they've been down or been going sideways. Look at that line. If this is 0%, which hasn't moved at all, what has SMH done over the last month? Nothing. Right? XLV, healthcare, nothing. A little negative. XLY, what's in XLY? The two major stocks in XLY, Tesla and Amazon, nothing. What's holding this up is Amazon because Tesla has been tanking over the last month. So the reason why this isn't down more than 2% is because Amazon's been holding it up. So if we go into XLY, I don't like that one. Two top holdings, Amazon, Tesla, Home Depot.
McDonald's,
and others, yeah. But just looking at the weights, Amazon, Tesla, and Home Depot are weighted more heavily here than McDonald's, Lowe's, etc. Right? So that's also what you have to look at is how heavily weighted. So if Amazon does really well, XLY is going to do really well, most likely, unless Tesla or something else or these two are holding it back, If Tesla and Amazon are doing really well, XLY is gonna go up, right? So, but if you look at the sector, that's been down, and then tech, XLK, has been the worst performing sector over the last month. Has been XLK tech. Why? Because Microsoft and Apple are the top two heavily weighted, and Microsoft has gone nowhere, and Apple has gone down. And Nvidia has been sideways too over the last month. AMD has gone down. It's been tanking. So that's why XLK has been the worst performing sector in the last month. So tech actually isn't the place to be right now. Until you start seeing this trend change, tech is pretty even or bearish right now. So that's why, from a day trading perspective, haven't been really trading tech lately until that changes. But if you've been waiting for some of your pullbacks on tech, this has been your time, right?
Yeah.
If you're long term and you're waiting, so from a long term standpoint, if you want to go look over the last year or the last 3 years, this is kind of where you would do it a little differently, where you want to see what's the most discounted over a 5-year period, right? It's been the regional banks. It's been XLY. So from a long-term standpoint, it might be a better time to get into Tesla now than there's ever been because it's more discounted. But you got to hold your nose for the crazy Elon stuff that's inevitably going to happen, And Tesla's just been performing weirdly lately. But if you look at Amazon, maybe looking at Amazon or healthcare or financials right now, because chips, if you look over the last 5 years, have been the best performing. Tech has been the best performing over the last 5 years, but they've been really expensive. So ideally, you want that stuff to pull back before you're buying it in your long-term account. All right, so that's macro. So I just wanted to show you the site because I've been monitoring it a lot more lately, just to go figure out what's the latest sentiment. But if you look at year to date, almost,
Yeah, I like that too.
Chips have been up year to date. Energy still though has been up year to date. But if you go look at the last month, the recent trends, you'll see that some of the tech has faltered. So just keep an eye on that. Wait for tech or chips to kind of come back up because right now they're not as bullish as they used to be. They're kind of in consolidation mode or potentially heading lower. All right, so that's that. Now let's go to the charts. Do you guys have Thinkorswim up?
Yeah, I'm gonna be doing it through the mobile.
All right.
I got my other phone, business phone, so I'm working on it through that way.
Hey, can you see my chart?
Yes, sir.
DeAndre, can you see my chart?
Yeah, I see it.
All right. Just going over some basics. When you get into Thinkorswim, you got all of these tabs. I don't know how it's going to look when you first get in, but the main place that you want to be, especially when you're first starting, is going to be in the charts tab. If you click inside here, you can put in any symbol. It's going to pull up the chart that you want. Another main area of the chart that I use is going to be the time frame setup. This is important because you need to know how far back you're looking. Are you looking at 5 years? Are you looking at 10 years? Are you looking at 1 year? Are you looking at 1 month, right? To figure out what you're doing. So just to toggle this, you're going to go to time frame. If you wanted something that's a little bit longer, you could do a time interval of 5 years, 10 years. I always usually start with a 5-year month chart. The aggregation period is going to be a month. And so that means that each candle that we see here is going to be representing a month. If you want to sync your charts, so like I'm going to be looking at multiple charts at once. If you're in your chart and it looks like this and you want to bring up 2 charts to look at them at once, you click this button and click on 2 squares. It'll bring up 2 charts, right? And let's say this one isn't SPY. Let's say this is AMD, some random chart, right? And I want it to sync with SPX. You see these tabs right here that says 3 or 1? I'm just going to click 1. And then that'll sync and make sure that we have the same symbol up. Let me go clear this chart. All right. So I'm just going over some basics in terms of the platform. That's how you sync. And
you said when you look at the chart, what year are you usually, or what time frame are you putting?
I start with a 5-year month chart. That's where I start. All right. And then you're going to have your watch lists that usually come up on this left side right here. And you can add certain things to your watch list. So if we're talking about adding things to the watch list, I'm trying to figure out. How do I, because I usually do this on my phone. It's a lot easier on the phone. Hold on, let me come out of here. Let's come back to that. It's a lot easier on the phone. Let's see, man. Oh, right here. So if you're on this chart and let's say you want to add SPX to your index watch list, like I have a watch list called Index Futures. This little button right here, the symbol actions, it'll click add SPX to watch list, and the watch list that you've created, you can add it to whatever watch list that you've created. In order to create a watch list, all you do is go into this side tab right here. You can click that open and close using this little arrow right here. You're going to click in here and then you're going to click create watch list. So if you create a watch list called indexes, index, click save. And then from here, you can either directly type in things here and add it to the watch list, or when you're scanning symbols, you'll see it'll pop up here, right? And you can add it. So that's how you create watch lists on your computers. On your phone, it's actually a lot easier. It's kind of similar. You can do the same thing, right? And then to get to your watch list, go to personal, bam, and it'll pull it up. You can change these gadgets. You could switch them. You could delete them, by right-clicking or clicking these little arrows in the corner right here. Just to give you some basic information on that. Time frames. Just to go over candles, some just basic information on what these candles represent. If you have a red candle, it means that this top right here where the thick part starts is where the stock opened on that month. This is based upon the time frame. So if we're on a month chart, these are representative of a month's worth of time. So that means starting, let me pull this over to the side. So if we're looking at this candle right here, that was April of 2023. No, April of 2022. So that would mean starting of April, this candle opened at 40.32. That would be what this range represents. And this is where the month ended right here, which would be at 41.31.93. And if you're looking like, how did I get this data? When I hover on this candle, look at this area right here, right? So right there is going to show you what was the high, the low, the open, and the close, right? You guys see that?
Yes, sir.
All right. So for the green candles, it is the exact opposite. The open is where the thick part starts in the bottom, and the close is where the thick part ends at the top. That means we had an up month. And the wicks on top of both candles are just going to represent highs and lows for the month. So this is the low, this is the high, this is the low, this is the high. This is where this opened, this is where this closed, this is where this candle opened, this is where this candle closed. Just to kind of read price movement using these candles that are on the chart. All right, so tools. Where do you find the tools? So let me remove my studies on this chart, right? So if you come to the chart, it's a 5-year month chart. This is how it's going to look. It's going to be a bare bones chart, right? Except for showing you where the 2019, 2020, 2021, 2022, 2023 years kind of started or ended, right? Actually shows it where they ended. This is what your chart's going to look like. So what would I first start doing is, make sure that you understand where your tools are. So right here is the quickest way to get to the tools. You can do it here, or you can come here and go to drawings. And then inside of here, they're going to be drawing tools. But I find it way easier to just click this button right there. All right, this is like the shortcut for it. So you have the major tools that I use are going to be the Fibonacci
Quick
retrace.
question, real quick. What
Yeah.
if you're like on the mobile? Where would you see that at?
Let me use my phone. On mobile, come on. If you're on a chart on mobile, you see where if you tap your finger on the chart, you see the white menu that comes up to the left.
Okay, but
And then there's a pen tool, and it'll say new drawing. And if you click in there, that's where all the tools are.
got it.
You see it?
Yeah.
So same thing. You can just draw all the tools with your fingers instead of with a mouse. But it's a lot easier if you're on a desktop. So the main tools that I use are going to be the Fibonacci retracements. Of course, the standard pointer and the pan tool. the trend line tool and the price level tools. Those are the tools that I primarily use. I don't really use many other tools other than that. I might use a rectangle tool or something here and there, or arrow tool, but it's mostly like for like drawing things on your chart, but it's primarily going to be those. So if we're talking about marking up a chart for the first time, actually, I was going to do that last. So that's where the tools are. Next thing, let's talk about indicators. Where your indicator is going to be located or how you're going to put them on your chart. You're going to go to studies. You can click add studies and either go through here, but I don't like doing that. I like clicking edit studies. And then you could just search for the study that you want. It's a lot faster than like going through all these drop down menus, right? And if you're on the phone, it's the same thing, but Isaac, on the left, it's the tool that looks like a beaker. You see the second one down?
Yeah, I'm looking.
If you tap your chart, it's the second symbol down where the first symbol.
Got it. Okay,
yep. It's a beaker, and that's where your studies are going to be if you're trading on a phone, right?
Okay.
On Thinkorswim specifically, right?
Yeah, that's what I'm using that platform to learn it now.
Got it. And I trade on my phone, especially if I'm mobile. I trade on my phone from time to time, but usually I sync the two. So like as long as I'm logged in here, all of the stuff that I'm charting on my phone or on my laptop is going to match my phone.
Got it.
And then, so if you want to buy shares, so not of the index, but let's go to SPY. It's an ETF. So I'm just going over basic mechanics. How do you buy shares of a stock? So if SPY right now is at 518.43. Sorry, let me move this. If SPY right now is at 518.43 and I wanted to buy it at its current price, and we're assuming the market's open, you can right click the screen, click buy. Wait, why is it giving me an auto buy? You know what? It's because I have something else triggered on my account where it doesn't. Let me do a buy order custom. This is how it's going to look on yours. So if I wanted to buy with a stop, I can right click it, click buy with the stop. If you click buy, because you guys don't have special settings, it'll give you this screen first. And actually, let me just do a single order. Bam. This is how it'll look if you right click buy, and you could put in the price that you want. So if it's this current price, you could put in a market order. What does a market order do? It gets you in at whatever price or whatever mark the stock is currently at. So I don't generally trade with market orders unless a stock is highly liquid. SPY is highly liquid. What do I mean by that? So the ask is what people are selling this for, and the bid is what people are willing to buy it for. It's only a 9-cent difference. So if you were to buy a market order of this, you're probably going to get it at 518.69, right? At whatever the market price is. Yeah, ideally what you want is to get it as close to the bid as possible, 60 or midway. But a 9-cent difference isn't going to make that big of a difference when you're buying stock. So this is one that I might do a market order with. But if you wanted it at a specific price, you're going to want a limit order. So if I wanted this, if it dropped to 500, then I would put in a limit order at 500. And what that would do, if I confirmed and sent it, this drops to 500, and you see how it popped up on my chart, it would automatically buy it for me. Right? You guys see how I did that?
Yes, sir.
Do not put in limit orders at prices higher, because sometimes you want to get in at a price or at a breakout. And when I first started trading, I made that mistake where, let's say I wanted to buy this when it got to 520, or let's say 550, right? Let's say I wanted to buy this when it got to 550. If I wanted to get this when it got to 550, if I put in a limit order right now at 550, the minute the market opens, it's gonna automatically buy it for me, right? Because when you're putting in limit orders, what you're telling is that if it drops to this price, or if this price is already at, or if it's already here, buy it immediately. So if I put in a limit order for 550, the minute the market opens, it's going to buy it because it's above this price. So the way that I would do this, if I wanted to buy this stock, if it got to 550, I wouldn't put in a limit order. I might put in a market order. Either I would set an alert to tell me to watch the platform once it got to like 545 or something like that, or I would set a market order on a stock that's pretty liquid, or ETF that's liquid, and then I would come in here in this tab right here, the settings wheel, and then I would say submit when SPY is greater than or equal to 550. And then what that would do, right, is if I confirm and sent that, it will put in an order, but it's set to not trigger this. You see how it says buy 10 SPY when SPY marked at or above 550? So even though it's on my chart, it won't trigger until SPY gets above 550. So if I wanted to buy something on a breakout, and I didn't, and I'm at work or something, and I know that the stock is liquid, so I don't care if I do a market order buy, that's how I would do it if it's higher. If it's lower, you could just put in a limit order. Any questions? Make sense, though?
Yeah.
Just in terms of market mechanics. Like, I feel that the hardest...
I need you to repeat that one more time. Like, just that section, like, what's the difference between placing the limit order, the way you did it? Like,
okay. So let's say I wanted SPY if it dropped to $500, right? It's at 518, but based upon my charting or my thesis or whatever it is, or somebody on YouTube said to buy it at $500, whatever it is, how you're trading, right? I want it at $500. So what I can do is if I right click the screen, you could click buy. And like I said, yours is going to look like this initially. I have a special setting where I skip this step so I can get into trades really fast, specifically for buying stocks. But this is how it's going to look. This is going to determine how many shares you have. So if you wanted to buy only one share, you could put that one. If you wanted to buy 100 shares, bam, right? This isn't going to matter as much. This is telling you that you're buying it. This is telling you what you're buying, that it's SPYs. Make sure you're buying the same thing. It's telling you that it's an ETF, not a stock. And let's say I wanted to buy it at 500. I would put in $500, and then I could put in a limit order. And that tells it to wait until it hits 500 to buy it, until it goes down and hits that level. And then it could either be good for that day or good till canceled. Right? Or an extended after hours. That's kind of, I would say, advanced stuff. So most of your stuff is going to be either good for that day or good until it's canceled if you want this to be here for a month or two or whenever you want this to expire, right? So if you're just looking to get in on that day and you want to buy it when it drops to 500, that is the trade that I would put in. If I wanted to buy 100 shares when it went to 500, that's how I would put that trade in. Conversely, if I wanted to buy this on a breakout, I only want it if it hits above a certain level, all right? Like if it goes above 550, this is usually for somebody that only wants to buy a stock if a stock is above its 200-day moving average, right? Like that's the only time that I want to buy it. Hold on for a second. So if I only want to buy this stock when it gets up to 550, I wouldn't put in a limit order here. Because if I put in a limit order here at 550, because this price is already below 550, it's automatically going to get me into a trade if I just do that, right? So limit orders are only for when you want a price to drop into that level. If you want this to go ahead.
So it would put you in the stock even though it's below the asking price?
No, this is above the current asking price right now. We're at 550.
Right, but you said if it came in at 540.
No, right now the current price of the stock is 518.43. You see that?
Okay, got you.
That's the current price. After hours, the closing price was 518.43 on Friday, right? So that's what it closed at. There's some after hours movement because you see there's like a 20-cent difference here, but the closing price is 518.43. So if I wanted to buy this at 550, which is well above the closing price, if I put in this limit order on Monday at 6:30, it's automatically going to get me in the trade, because what I'm telling this to do is to get me in if the price drops to 550. The price is already below 550, so it's going to get me in even though my intention was to get in at 550, right? So the way that I would trade this would be I would change this to a market order. This is if I wanted it to auto trigger. I would change this to a market order. I would go on this particular wheel right here. And then I would say, hey, only put me in this trade, right? It's telling only submit when this condition is met. If the mark, which is this, is greater than or equal to 550, then buy 10 shares of SPY.
Okay.
So even if I submit this, it'll be on my chart, but this is going to keep moving up until it hits 550. And then at 550 is when this will trigger to buy 10 shares. And you see the description, the white description underneath it. It says buy SPY mark at or above 550. So it won't even execute until it's at 550.
Okay.
And then what you could do, if you didn't want to do a market order, if I wanted this, and you'll see too, like when you hover on this area, like if I'm hovering around 550 and I click buy right there, it's going to give me close to the price that I was hovering over with my mouse, right? So if I did want this and I wanted to put in a limit order and I only want this at 550, or let's say 550.05 or something like that, that's what I wanted. What I could do is then I could put in a limit order here. Or actually, if I say I wanted it right there, then I could still do the same thing and put the trigger. And that's my trigger. The only difference is it's like, if you've ever watched these things when they're breaking out, this thing could break out fast, right? Isaac, I know you've seen that. Like
absolutely.
If it pops, it could take off on you. So if you're trading a breakout, if you put in a limit order and you don't trigger it until it hits to 550, you might not ever get in the trade. So when you do a market order, it tells me buy it at wherever it is right now. So if you think this thing is going to go to the moon and you wanted to catch it right at a breakout, I usually use market orders if I really want to get in the trade and I'm not going to be watching it, like, because if you're putting in limit orders and it keeps going higher and keeps going higher, you could end up chasing a stock versus getting in when it's 5 or 10 cents higher than where you wanted it to be. Because if I'm buying 100 shares of something, I don't really care about a 5-10 cent difference. I care about $1. I care about $2, but 5 or 10 cents is not going to make that big of a difference to me. So that's how I would trade it.
Yeah. So just to clarify, a limit order is a number that you put in that you're willing to own the stock at that number that you put in. When it dips or falls, if it gets to that number that you actually entered, you're going to own it at that number. Now, the market one is whenever the market it's going to put it at that certain number that the market's been peaking or hitting multiple times, and it's going to assign you whatever the market's at that time.
Not necessarily a market. So let's say if the bid and the ask right now are 518.60 and 518.69, If I did a market order, it's automatically going to give me the most expensive fill price right now at 518.69.
Got it.
Versus, let's go look at something less liquid. No, that's even pretty good. Versus here, ASML. The difference between the bid and the ask here is what? A few dollars, right? So there's a big difference if you paid $985.90 for something versus $978. So if you did a market order on ASML, you could be potentially giving up what, $7, $8.
If you did a market bid.
If you did a market order, it's going to fill you at $985.90. And so versus SPY, the difference is only 9 cents versus $8. So I wouldn't advise doing a market order if you're buying ASML, because there could be an $8 difference versus SPY. 9 cents is a lot easier to swallow than $8 per share.
Got it.
Right.
Understood.
So be careful when you're doing market orders. But that's what I would look at, is this is when we say liquidity, we're looking at the liquidity. If there's such a small difference between what people are willing to buy it and sell it for, then you can get in and out of the stock really easy. Shorting shares, it's the same thing. We talked about shorting before. I found a better definition for it the other day. Let me look at my definition. Short selling a stock is when a trader borrows shares from a broker like TD Ameritrade or Schwab and immediately sells them with the expectation that the share price will fall shortly after. If it does, the trader can buy the shares back at the lower price, return them to the broker, and keep the difference minus any loan interest as profit. Right?
That's the definition of what again? One more time?
Short selling.
Short selling. Okay.
So, for instance, if I think SPY is going to drop on Monday, I think it's going to drop to 500. So it's at 518. What I could do is, if the market opened at 630, I could sell 10 shares of SPY, let's say at what the current price is, 518.43. I could sell 10 shares of this at 518.43. But what I'm doing is I am borrowing those shares from Schwab or TD Ameritrade to sell to somebody else at 518. And then my goal is to buy them back for $500 and then return those shares to Schwab or TD Ameritrade, right? And then I would have made $18 per share if it gets down to $500. So let's say if I sold this at 518.43 and then I buy it back, buying it back would close out your trade for $500 because you have to return the shares to the broker that you borrowed. So then I would make 18 times 10, which is what, $1,800, minus the cost to borrow, because they charge you a borrowing cost for borrowing these shares that you don't own to sell to somebody else. So that's what it means to short a stock. So if you believe a stock or ETF is going to go down, you can borrow shares from your platform. You're going to need a margin account for that. And then if the stock goes down, like I said, in this case, to $500, you would make $18 a share. So 18 times 10, I believe it's $1,800. Is that 1,800 or 180?
It's 180.
My bad, 180. My bad. That's lawyer math. So you would have made $180 if you did 10 shares, 1,800 if you shorted 100 shares, right?
Now, how much do you need in your to be able to bet on margin?
Depends upon your platform, but generally, I'm not sure exactly. But it usually depends.
I want to say 25K. Usually, my platform is 25K.
Yeah.
Okay.
But you got to have a margin account. So hey, hush, Mamba. Essentially, to borrow shares, you need a margin account. So that's what you're doing is borrowing shares from the platform, betting on the stock to go downward. If it goes down, you make money. Versus if it goes up, let's say it goes up to 550, you lose money because then you're going to have to buy these shares back at a higher price to return them to the broker. But now you bought these shares at 550, so you lost what, $32 on every share. So you would lose money if it goes up, you would make money if it goes down. And then sometimes if it goes up too much, they might margin call you where they'll say, hey, you don't have enough money in your account. We're going to get you out of this trade right now. And you got to pay us. You got to pay us now, you know? So if you let this go too far and you don't have enough cash in your account, you can get margin called by your platform where they'll say, nope, we're not going to let you take this all the way up to $600. We're going to get you out of this trade right now. And your loss is X, you know? So
Gotcha.
that's shorting a stock. That is the most traditional way to bet on a stock going down. Buying shares is the traditional way to bet on a stock going up. Shorting a stock by selling shares is the traditional way of making money going down. Now, you can also do these trades in here by using the active trader tab on the side of your chart in Thinkorswim. For people who are doing really fast trades, a lot of this is a lot easier. You know, if you wanted to buy something at the current price, you could just click this button and it'll buy it. Right? If you wanted to sell or short right here, you could click this button and it'll short for you right there. 10 shares or 100 shares, wherever you put. You see how quick that was?
Where's that button again?
So,
All right, fellas, I'm out of here.
all right, deuces, next week.
All right.
So right here on this chart, you see all of these tabs right here? You got your trade tab right there, your time and sales tab, the active trader on TOS or Thinkorswim. The active trader tab. This is the quick way. This is where a lot of day traders that just sell stock or short stock and or options at specific prices, but they only do calls and don't do complicated spreads. This is the easiest place to kind of put on your trade quickly.
Okay.
Especially if you know, hey, I know I'm going to take this with 10 shares or 20 shares or whatever. Or I know, hey, I want to do something else. You could trade OCO or something like that. You know, this is how I want to do it. But this is the quickest way to get in and out without fiddling around with all these right clicking and stuff like that, you know?
Right.
So you could just go, bam, get in for 10. Bam, get out for 10. So like if I want to bam here and I want to place a stop here or I want to place a target here, like if I got in for here and I'm in the trade and then I want to place a quick stop somewhere, I could just put a stop in really quickly or I can put a target in really quickly if I'm just
What's
buying
the stop?
something where you know like, hey, if this goes down to 500, I want to automatically get out the trade even if I'm at work and I don't want to look at it.
Okay.
And the market's open, it'll automatically get me out.
Okay.
So if I bought this at 518.43 and I said, hey, if this goes below 500, I don't want to be in this trade anymore, I could just automate my stop. And when I do that, it'll automatically get me out if this goes below 500 while the market's open.
And then what happens to the stuff that I purchased before it got to that price?
Well, you sold it. That's what a stop is. It's selling. It's just automated selling. And this is good. So let's say on Monday we announce we go to war with Iran. On Monday, China announces they're going to war with Taiwan, and the stock market is dropping. Now, if you're paying attention, great. You can go get yourself out. But what if you're at work? What if you're in a session and you can't get to your computer at the time, right? I'm going to be out the trade because I automate my stops for a lot of things. So while other people are panicking or they can't get out, like I'm just going to get an alert on my phone that says it sold X amount of shares of ASML. You know?
So pretty much damage control.
Exactly.
Right.
And especially as a newer trader or a newer investor, I always recommend putting stops until you really understand what you're doing. In this new class I'm taking, we don't do stops. We're mostly trading and swing trading. We're not doing long-term investing, but we use alerts. So instead of placing a stop, So if I wanted to place a stop at 500, I could do that. I could do sell. And then here, instead of limit, you would put stop. Your stop would be, it would sell at the market price at, if it gets below $500. And you could, I always put good till canceled. And that's where we'll put a stop on SPY if I own some shares of SPY. And bam, right? Actually, let me show you one how it looks on a.
Say that get to cancel one more time, because when I first started too, if you don't change it to get it to cancel, it's just like a daily thing, and sometimes people think you just got it in there, and it's not good until you
Yep.
put like you switch it out to that get to cancel.
Yep, you need to make sure that it says good till canceled. Otherwise, it'll come off after that day, and you think you're protected, and you're not. So here
Uh,
on ASML, I own 21 shares in my IRA right now. So I have a stop right here at where I bought it. Since it's popped up from where I bought it, I'm not willing to take a loss on this stock. So I placed the stop at the exact price where I bought it. So at worst case, I'm going to break even if this comes down. Best case, I make money. Worst case, I break even. And so it's just an auto stop that's triggered at my sell price. I bought this at 918.68. So if this drops down to 918.68 is and during the market hours, it's just gonna sell my 21 shares. And you see
okay.
it stays on your chart. And
And
then
that says you have that listed as good until cancel.
yes, you see it says GTC on it right after the price.
Uh, oh
Yep,
yeah,
yep, it's good till cancel.
yeah.
And pretty much just meaning that it'll either assign it or it's just gonna cancel once you cancel it. You got to cancel it.
Yeah, it's either gonna trigger it, or I need to click this X or cancel it or something, and then because I'll move my stop up. Like if this breaks the high, I'll probably move my stop up. But I'm keeping it here at where I entered until it breaks this high. If it breaks this high, I might move my stop up a little bit. You know. But this is a long-term position, so I'm giving this a little wiggle, especially at least the price that I bought it for. Because worst case scenario, I'll make zero and lose zero. You know. But and then for me, this keeps me from being emotional about a trade. If I'm like, oh, I don't know, this is what I said I was gonna do is break even. So even if this comes all the way down, what am I up on this trade right now? I'm up $1,200 on this trade right now. So even if it comes all the way down to zero, I'm willing to break even lose all of these unrealized gains. That's fine because that's what I said I was gonna do. So I placed the stop. On Google, conversely, I have an alert because I bought a leap on this. So I have an alert that says, hey, if this gets back down to the price where I bought this option, get me out, you know. But this one's still up. I still like Google long term. I like where it's headed. I like that we're still in a bullish market, so I held on to it. But I have an alert stop on it. So let me go to Google. And so if we go to Market Watch, an alert, right? That's my alert. And then I even put notes in there. That's my break even stop loss. If that option price comes back down to 59.30, that's my break even. That tells me to get out of this position for right now. So you could set alerts on your options too, Isaac. So let me show you how to do that.
Okay.
Where am I at? I bought a leap. What contract am I in? It's on IWM. That's why. Right here. Here it is. So if you're in an open position, you see this little tab. It'll tell you where you have an option open.
Yeah.
And so here's my leap right here, heavy in the money. If I wanted to set an alert on that, I could do bam, create alert. And then I can say, hey, when this mark is at or below whatever price I want, sell. If that's my first target, buy, whatever, right? Same thing. And then if you want to set an alert on the stock, so like if you wanted to set an alert on the stock, you could right click it and create alert. So if you wanted, like for instance, me right now, I'm almost certain I have one on Apple right now. because I know exactly where I want Apple. I want Apple at 166. It's almost there. Um, right? Yep, I got an alert there at 167. So that's what I'm saying. Um, and that's just for me. I'm not even really watching it right now. I just know. I know if Apple gets to like that level, it almost hit it. And if it gets to that 160, if it gets to that 165, 166 level, probably really 166. If it cracks 166, I'm gonna at least take a swing at it, um, just because of historical price movement. Last time I literally bought it there a few months ago and swung it up to like 189, sold it, and then I intend to do it again. Um, I think it's dropped a lot. It still is a risk because it's in a downturn, but what I do like about it is that it's above its 200-day average. So actually, let's start with this stock. So let's say I'm looking to buy Apple for the first time, right? I'm looking to buy Apple for the first time. How am I looking? Look at this. Look at these lows, right? That's why I'm trying to buy it there. 1, 2, these are monthly lows in that 166 range. This low is 165.67. So if that shit gets to 166, it's a good chance it's going to bounce. It's a good chance it's going to bounce or it's going to keep going down. But this gives me a good risk reward setup, right? My reward, like let's say if I take this at 166, even 167 where I want it. If I take this at 166 and keep a stop at like 164, right? $2. You see how that's a $2 risk? Let me know if I'm missing you guys.
Nah, yeah, I got you.
So if I take this at 167 or 16, if I take this at 167 and put a stop at 164, that's a $3 risk. If I take this at 166 and then put a stop at 164, that's a $2 risk. So let's say I'm risking $2 to $3 potentially to swing this all the way back up to like 196. So let me see. 196, that's $30, right? 196 minus 166 is about $30 of reward for $2 of risk. So that's a 15 to 1 risk reward trade. Do you see how I got into those numbers?
You're giving yourself a cushion. You're not going to let it fall below 164
I'm
with the
selling.
hope
I'll
of it
buy
jumping
if
all the way back up and you making that big profit turn.
yes. So I'm only willing to let it wiggle to like 164. Why? Why? Because this is the low. It's telling me it's bouncing off of this level, right? Once, twice, 3 times, right? It's bouncing off of this level. So if I get in around like 160, my ideal price is 166. If I can get in at 166, that's my ideal price. I'll give it some wiggle down to 164, $2. So if I go into Apple, I'll probably go into this with 100 shares. So I'm willing to risk $200, $2 per share if I get in at 166. So my risk is $200. If it goes below 164, I cut it. I drop it. Apple's probably going to go lower, right? So I'm risking $2 to potentially make 30. So I'm risking $200 to make 300 times, or no, 30 times 100 to make 3,000. You see how I got that risk to reward ratio?
Yeah.
On those numbers that you're plotting based on those.
Yes, because look at the highs. So the high, it looks like that it's going to get to before potentially Apple comes back down again. It's been coming up to that 196. So that would be like my main target. Probably target 2. I probably would have an intermediate target before that. But that's where my target's going to be, approximately 196. If I were to take this trade. You see? Where did it stop last time? Stopped here, stopped here, stopped here, stopped here, right? Where did it stop here? Here, here, and here. So for me, a good risk on this trade would be taking this at 167 to 166 risking $2 or $3 to make 30. So that trade, if I get it at 197, is going to be a 10-to-1 risk reward ratio. If I get it at 166, it's going to be a 15-to-1 risk reward ratio. And then my stop is going to be right there. So I'm only going to risk this much wiggle. If it goes below 164, I don't like round numbers. I'll probably have my stop at 163.95 or 163.90 or something, because things tend to bounce at these whole numbers. I might even go, what's this low right here? That low was 164.31. Yeah. So once I would risk this amount, the difference between this yellow line and this green line, to make the difference between this yellow line and this green line. Can you see visually the difference between the risk and the reward?
Yes.
This is so if I use this rectangular tool, this rectangle, crap. Dang it. It's not letting me draw. Anyway, can I? It should be letting me draw a rectangle, but it's not. It's not. This area right here represents risk. This area right here represents reward. You always want to be in trades where the reward is way bigger than your risk.
Do that again.
This area represents your reward. This area represents your risk. You always want to be in trades where your reward is way higher than your risk. If this trade goes really well, I have a potential to make $3,000. If this trade goes bad, the most I'm going to lose is $200. I would trade $200 for $3,000 any day of the week.
Right.
From a risk, even if I lose that $200, I would take a chance on winning $3,000 by paying $200 if there was a good chance that I would win. And I'm doing that based upon price action. Price action is telling me that when it gets to 167 or 166, this has bounced in the recent past. So I'm betting on it to do that again. If it doesn't, I'm willing to lose $200. But if it bounces again, I can make $3,000 if I take 100 shares.
Got it.
Right? If you take 10 shares, then you're risking $20 to make 300. Same math, just a smaller quantity. And what I've been noticing lately, I've been taking these things with size because I don't care about making $300. I want to make 3,000. So I'll take this with size. I'll take it with 100 shares instead of 10. And you could also do this with a leap. You could do this with options. We're not going to go into that today. The last thing I want to do before we leave is just, okay, we're coming to, let's say I'm taking this stuff off, remove. How would I come to Apple for the first time if I have a blank chart? First thing I would do is put these fib levels on it at the high, on a 5-year chart. So 199.62 to the low is 42.57. If you want to change these numbers, you can right click it, go to edit properties to make sure that they're accurate. So the low is 42.57 and the high is 199.62. Right? So those are perfect, right? These are essentially showing you like support and resistance using Fibonacci levels derived from Fibonacci sequences, which are like expressed as percentages. They also show you how much a stock is discounted. Like right now, I can see Apple is like 22% off, right? If it gets down to that 166
So
number.
real quick, this is called the Fibonacci. Say that again. It's called the what?
Fibonacci retracements. This tool.
Got it.
It looks like a percentage.
Okay.
right? And look where that fib level lines up. What number is it on?
79.66.
No, but I'm saying right here. This no, but what price level is that?
That 160. What is it?
118.50.
6601
Yes. What level did I say I wanted to buy this at?
at 166 or 167.
Yep. So they line up. And I see I didn't even have this on the chart initially, but that's why I want to buy it at 166 because the fib levels are telling me where it tends to bounce off these fib levels is telling me that 166 is like the perfect price. That's why I said I might hop in a little earlier at 167, but that's the perfect price based upon looking at the fib levels. Right now, this is going to serve as support. What does support means? It means the place that a stock is likely to bounce. What's going to serve as resistance is the top level is going to serve as resistance. A stock that a place that a stock is likely going to go down. So looking at the natural support and resistance level, it looks like it has some support at 166, which is where I want to buy this thing at. That's my ideal price to buy Apple. And the place that I want to sell it is at 196 before it even gets to resistance. If I'm swinging this thing, right? So that's Apple. So that's the first thing that I would do. The next thing that I'm going to do is I always like my moving averages because those are like dynamic support and resistance. They're not going to be flat lines. They're going to move. They're like average price ranges. But they also, you'll see, serve as really good support and resistance. I don't like using the simple moving average. I like using the exponential moving average because it takes more recent price into consideration rather than just doing like a flat average throughout that time period, right? So bam, I always put 4 on. I used to do 3. I usually do my 21. I make that green. I do my 50. Well, 34 now. I make that orange. I'll do my 50. I keep that blue. And then my 200, I keep yellow. Or gold. Right? So here are your moving averages. This is a moving average on a monthly chart, though. You got to remember when you're doing moving averages, it's based upon the period. So if you're on a month chart, this is going to be a 21-month moving average. This is going to be a 34-month moving average. Versus if I switch to a daily chart, this is going to be a 200-day moving average. This is a 50-day moving average. This is a 34-day moving average. This is a 21-day moving average, right?
And where is that modification at? Where you move from day to month?
There is no right here in the time frame. When you switch the time
Okay.
frame, the averages will automatically move to that time frame. So if I had a weekly chart, here is a 21-week moving average, a 34-week moving average, a 50-week moving average, a 200-week moving average.
And that's next to the settings icon.
Yes, your time
Okay.
frame. But that's very important. So if you're on a 5-year month chart, don't think that this is a daily moving average. This is a monthly moving average. If you're on a day chart, now this is a daily moving average. And Apple looks kind of bad right now technically. Why? Because this 50 is crossing below the 200. I usually like to buy stocks when they're on top of the 200. The only reason I like Apple is because I don't think Apple's going anywhere anytime soon. And like, Apple rarely gets discounted. So I'm willing to take
Yeah, this is a good time.
I'm willing to take a risk, and because the risk reward is so small. The risk ratio is small. I'm only willing to take it if it doesn't drop below 164. But I bought it here last time. I literally bought Apple last time. I think it was on this day or on this day last time. And then I sold it around 189 last time. That's how I swung it last time. Oh, the reason why I swung it there, because I saw this top right there. I think I sold it around 189. I let it wiggle a little bit on one of these days last time. So I made that 166 to that 189 last time that I bought Apple. I'm planning on doing the same thing again. We'll see if it drops there, because even right now it's looking like it's consolidating. But I just think that's a good place to get it, because history has told us last time that's where it bounced. But yeah, but these are the moving averages. This is kind of how I would like have a basic chart setup. The other thing that I might want to put on there is the RSI. This is going to show you if something is oversold or not. I usually do 10 days because it's the last 2 weeks of the market, 10 trading days. And then I put these at 20 and 80. It's oversold if it gets to 20 or 30, and it's overbought if it gets to 70 or 80. And apply, right? And Apple, yeah, it could fall a little bit more, but look at it's more oversold than it's overbought. But the price that I'm really looking at is that 166 level. Also, I can go look at the options. What the heck? What happened? Oh, it's an active trader. That's right. I like to go look at the options on Apple. And I like to go see where like all the volume is like hiding out, even if let's say we go a week out further. Like look at where all the volume is. 165 at 170. Some people wanted to go to 160, So just looking at like your targets too, Isaac, specifically because you look at a lot of options. Look, a lot of people love Apple at 160.
Mm-hmm.
So even
So they're buying. Those are buying calls? Because I can't zoom in and see it this time.
It's more so just open interest at like the level. Yeah, this is the call,
Okay.
but it just shows you what levels people are interested at buying a call at, right? They're
Right.
interested in buying a call if it gets to 160.
Yeah.
And there's just a ton of volume there or interest there, So I'm always looking at that. And at 165, there's a lot of people already in at 165. 5,000 here, Even this one. Some people don't think it's going to drop past 167.5, which is why I said 167. And it could drop to 160, and I'm willing to lose $200 to see if it's going to bounce before 164. That's why I said you
could give yourself time too. Like I said, make it a longer call, and
or leap. Yeah, you could take a leap or do a spread on it, depending on if you're just trading it. Me, I kind of like it, like because Apple might come down when I'm in the middle of work. I might just place a limit order at 166. In fact, you know what? I'm gonna do that shit right now.
Yeah, that's funny. I already put my word for that.
Not even. I don't even need an alert. Like if that shit drops there, I want it. I don't even need. I already know I want it there. So
yeah,
I'll just show you how I'll plug in the trade right now. I'll probably buy it in this one.
Over there, okay? Let's see. Okay, you guys, go ahead and look on the screen. There she is. Perfect.
So now 163, 90. I'll put it at like 90. Go to cancel. Right? Now it's programmed. So if Apple over the next week drops to 166, it's just going to get me in a trade. In fact, I'm going to revise that. Damn. Can I cancel and replace order? Bam. Right? So those are automated. So it'll automatically buy me some Apple if it gets there.
Cool.
Right? Any questions? I think we're going to end there, but y'all feel me?
Yeah.
That's the main thing that I wanted to emphasize today is risk reward. Do not get into a trade if you don't know what the risk reward is, where you're going to get out, where you're going to get in. Like, you need to know your risk reward, and ideally you're taking trades with lower risk and higher reward, you know. Like I said, and then my out will be, I know, like I said, my top target.
Yes, sir. Good game today.
Yeah.
Appreciate the
Yeah,
info.
appreciate it, man.
Right. All right, that's it for this week. But yeah, any
All right, catch
questions?
you next week, brother.
Next week we'll do something similar.
Yeah,
But
this was helpful. Appreciate you.
yeah, peace.
Peace.
Peace.